We are living through a time when it is particularly difficult to raise money for a young business. Banks are not lending, not that it was ever easy to get them to lend to young businesses, and other investors can be difficult to find. In response to this, the government has introduced a new tax scheme to lower the risk of investing money in a young small business. The scheme is called the Seed Enterprise Investment Scheme, or SEIS. If the trade carried on by your company is less than 2 years old, with fewer than 25 employees and no more than £200,000 in gross assets, then your company could be eligible to receive funds through SEIS. The opportunity to lower the risk and increase the returns for your investors can help you raise money by making you a more attractive investment. SEIS is similar to the more widely known Enterprise Investment Scheme and, in fact, is modeled on it, but it differs in a variety of significant ways. First, the investor gets income tax relief of up to 50% of the amount invested, regardless of the investor's marginal tax rate. Second, investors avoid paying capital gains tax on any assets sold during the tax year, ending 5th April 2013, as long as they reinvest the gain in an SEIS-eligible startup in the same year. Like the Enterprise Investment Scheme, the investment also avoids capital gains tax if the company is sold for a profit after 3 years or more. On the other hand, if the company should go bust, the investor may also be able to claim loss relief at their income tax rate on the investment which has not already received income tax relief. Let's work through an example. On an SEIS investment of £100,000, the maximum permitted each tax year, the investor would receive £50,000 as a reduction in their income tax liability. They could exempt £100,000 of capital gains by reinvesting in SEIS, saving £28,000 of CGT. And finally, they could offset £50,000 of losses if the investment completely failed against their income tax liability, potentially saving a 45% rate taxpayer £22,500. This would give total tax relief of £100,500 on an investment of £100,000. In short, if the investment goes bad, they are potentially protected to 100.5% of their investment. If the company succeeds, you amplify the value of their investment tremendously. Let's see what happens. If they invest £100,000 and take advantage of the full income tax and capital gains tax relief, they immediately save £78,000. Let's assume for the purposes of discussion that you sell the company 3 years later for 2 times the value of their investment. That's a gross return of £200,000. In the normal course of affairs, they would pay 28% capital gains tax on the gain of £100,000, equaling £28,000 of tax, netting them £172,000. Thus, in the absence of SEIS, they would be investing £100,000 for a return of £172,000. Under SEIS, though, after income tax relief of £50,000 and the capital gains tax exemption of £28,000, they have effectively invested only £22,000 for a return of £200,000. That's a 72% profit versus an astonishing 809% profit. There are restrictions on the type of companies that are SEIS eligible. The company must be undertaking or preparing to undertake a new qualifying trade, and not all trades qualify. And HMRC will run checks to make sure that a business hasn't just been set up merely to access the relief. The company can only receive £150,000 under this program, and the maximum shareholding of an SEIS shareholder is 30%. In conclusion, whether you are a young company looking for early capital or someone with a small amount of money that you would like to put to work, SEIS is undoubtedly one of the most interesting opportunities that has ever arisen.